Let's get more on the markets. We're joined by Jon Mackay, Head of Platforms, US Client Group at Schroders. It's great to see you, and thanks very much for coming on the show.
Thanks for having me. Great to be here.
This is kind of a woolly question, I know, but when you look at the market, do you get a feeling of excessive euphoria right now?
That's a great question, and one that's been coming up in a lot of client discussions, partly because they've got a real alternative these days, which is sitting in cash. So the question basically is phrased along the lines of, should I get off the sidelines now, given the strength in the market we've seen so far this year? So I think there are certain parts of the market that do look like they're in hype territory or excess territory, or they've been a victim of FOMO. A lot of people trying to dive in, given the recent success we've seen, and they tend to be in the tech growthier areas of the market. And then there are other areas of the market that look pretty attractive to us, despite the run up at the index level. So we still see opportunities out there, but we're not ones to jump in and chase the recent winners.
You do think that there's a decent chance we'll see some broadening out into other stocks, not just a few tech darlings?
We do. We think we're in an environment right now that is going to persist for the foreseeable future, which is basically persistently higher inflation. Yes, we'll have ups and downs. We're in a disinflationary period right now, but we do think inflation is going to stay higher for longer. That will leave interest rates higher for longer. It's going to be tougher for the Fed or other central banks to cut to zero, which is what everyone was used to prior to the pandemic. And so that means valuations will matter a lot. And so what we think will happen over the next 3, 6, 9 months is you'll get a broadening out. One scenario would be that we have a soft landing, we have no recession, the markets don't fall a lot. But instead of it being just a narrow market that was dominated by a few big tech players, you get other areas of the market that have been left behind. Energy, for example, starting to catch up a little bit and narrow that gap. The other scenario would be the markets do sell off because they've gone too far and the growth outlook starts to weaken. And in that scenario, our expectation would be you will also get a broadening out and that the recent winners become the biggest losers in a downside scenario.
So sectors that you think look decent, I believe, include industrials, materials, and energy?
Yeah, energy in particular really stands out. I think I was looking at some charts before we got on the air, and from an earnings perspective, energy is really taking it on the chin, not surprisingly, given the fall in oil prices over the last year or so. $120 or so in June of last year for WTI, all the way down to $70. Now we're back up to $80. But that obviously is a hit to earnings for energy companies. But the expectations, I think, are what really matters. Going forward, energy, based on bottoms-up consensus expectations, is the lowest growth area from an earnings perspective for the S&P 500, and it's not reflected in the prices. That is reflected in the prices. So if I was going to put $1 to work in the market, I think energy sort of stands out based on our view that we think oil prices can move higher from here, and that energy stocks look to be pretty good value based on very low expectations.
What about the banks, the U.S. banks? Is it fair? I mean, it's obviously simplistic to say they always do well when interest rates rise, but are they in a sweet spot now? We've seen this increase in borrowing costs.
That's a tough one to answer. I mean, I would separate them into the really big banks, the banks that are truly too big to fail, without naming names. I think we know who they are. And then the regional banks that are dealing with more strict regulatory scrutiny. They're going through, we just got the Fed bank lending survey, and they're dealing with less credit demand, which is their lifeblood, as well as tighter lending conditions. They're lending less money. And so I think the cost of lending has gone up a lot for these banks. It's eating into their return on equity. And I think that area of the market doesn't really stand out to us, almost no matter what interest rates do from here. If they fall, the banks, are going to get less money on their loans. If interest rates rise, they're going to have to pay more for deposits. So unless you have a more diversified model like some of the big banks do, I think it's going to be tough sledding for some of those banks for the foreseeable future. So we prefer to go big in the banking space.
Just turning to international, you think Japan looks decent right now. Why is that?
So it's been a long time coming. The Nikkei and the topics recently hit levels we haven't seen in about 30 years. Japan for such a long time has been sort of this disinflationary, deflationary story where you just couldn't get good return on equity there. And I think all of the measures that have been put in place, from Abenomics through recent initiatives around return on capital that is being put in place by the stock exchanges there, and inflation, part of which was not Japan's own doing, that came out of the COVID pandemic. You're seeing in a market environment there that most people have not been able to make money in for 30 years, and finally is showing signs of life and remains cheap, and just sentiment remains pretty poor. As much as people are saying, oh, Japan looks like a decent opportunity, we're hearing that more and more in client conversations, and they're not positioned that way. So our view is that you could see quite a rebound that lasts several years in Japan equity markets.